Krishna, you're the new guy at the table, so let's talk a little bit about what you've seen. You had been calling for a pullback. You thought we'd see 10%, but we got there awfully quickly.
Yes. So I think I've been probably the longest bull who has showed up on your show over the last 10 years. But this time is different. This time is different because we are talking about a disease that has a significant impact on activity level that cannot really be changed. And I think that is the key point. Everyone seems to be focusing on the infection, but real issue for investors is the impact on activity. So if things are going to turn around, it's going to turn around because we are seeing a bottoming on the impact, bottoming in terms of the activity level.
And the economic impact.
And that is not going to come from what's happening in California or Italy. That is actually going to come from China. Because China has dealt with this situation the longest. We'll get Chinese PMI. If the PMI is in the 40s as opposed to 30s, I think the market bottoms out. But we don't know that just yet. So as an investor, you are in a risk management mode. And what risk management requires you to do is to basically fall back and wait for a better, stay alive to play another day.
If China, if it does look like the incidence is peaking, and it's hard to believe that, they're not testing everyone, obviously. But if you do start to believe that it's peaking and President Xi starts what he started last week, and that is talking about sending people back. We got to get these things reopened. We're going to do it either way. And he did start doing that. So if both of those things happen, that could be a model for what happens.
That is exactly, if the market is going to turn around, it's not going to turn around because we found a magic cure for the infections or all of a sudden things died down. I don't think that is likely to happen. What is likely to happen is the impact on the activity level starts bottoming out.
Can we just say, though, China took some incredibly severe restrictions by really quarantining millions of people and tying down those areas. If we are watching it be effective with China coming out of this and saying they are not seeing lots of new cases, we still have to live through that here, potentially.
Oh, absolutely. But I think the difference between China and the U.S. or Italy, for example, or other countries, is we are aware of what the potential is. And therefore, the effective steps that people are taking more severe, which kind of counterbalance that. I'm not an epidemiologist, but what I can tell you is if things are going to bottom out, it's going to bottom because things are not as bad in China as they looked like a month ago.
Kevin, let's talk a little bit about what Mike was just mentioning. What could be useful from the Fed is the idea that you've seen those high-yield bonds that have really had investors pulling back in a big way from them. If the Fed cuts rates, that supports that issue. But I start to think about it. I mean, I've thought that high-yield bonds have not been given enough scrutiny by investors for a while, that they've been riding along at those same rates. That's a good thing or a bad thing?
So there's been a lot of complacency broadly across these markets, and to some degree that's been encouraged by central banks over the last 9 years. But the complacency gets destroyed pretty quickly. There's been a tough last 36 hours in the credit markets, especially in the lesser quality, high-quality names, as was referenced earlier. So central banks spend a lot of time thinking about what's happening in credit markets, seeing it, and they have to be somewhat troubled by events of the most recent day or two.
Mike, I start to wonder about potential deals that had been in the works. How many of those are just frozen at this point?
I think a lot of things. First of all, I mean, just to stay with corporate credit, there was no issuance of corporate debt for the first 3 days of this week, which is rare. I mean, it's been a very wide open market, so that you're starting to see that almost immediately. We're not seeing IPOs. I mean, I think that does go on a standstill, and it does speak to just the speed with which we've repriced these markets. And it's similar, like I said, to what happened in 2018, but almost more so. I think the issue is, I mean, to Krishna's point, we're not waiting for the soothing headline that tells us everything is okay.
Right. You're
waiting for the market to rush to a place where it's already priced in something really nasty, and then we get something less nasty, or time goes by. We don't have the. It's close. It's close in time. It might not be close in price. Maybe you need more of a whoosh down. Maybe you have to scare more people. I think one of the issues that's also knocked loose is that you had people here, investors, overcommitted to a subset of stocks that are now just being completely exited, right? So you have Microsoft gets to 185. Nobody can find a reason to sell it. It's in the 150s right now. Not really because of the coronavirus fears, but because people own too much. And so now that kind of idea that, volatility's low, rates are low, we can own more equity risk is going in reverse.
I think two observations on that count. I think credit markets have certainly priced in a bit of the downside, but I think relative to what the potential is, they are nowhere close. So
they're not leading us into this.
Absolutely, right. And I think from that standpoint, to Mr. Warsh's point, if the Fed wanted to arrest this downtrend, they actually have an opportunity, and that'll have an impact on the credit markets. The second thing, as an equity investor, I want to believe what Mike's saying, but I can't. I don't know.
You want to believe which part?
You can't believe which part?
The fact that it is close to the bottom, because I think, yes, I think...
You didn't say that, though.
Yeah,
I think it's a plausible place, but guess what? We overshoot all the time.
Absolutely. So. And I think if this was really driven by analyzing what the Fed is going to do, or what the U.S. Congress is going to do, or what Mr. Trump is going to do, we can speculate. This we cannot. So I think that's the difference about this relative to every other point.
I agree with that, except that we've always had these situations before. We've had wars. We had 9/11, where you had this incalculable, set of possible outcomes, and nobody had a feeling that you had a grasp on exactly how it was going to go. But the market, kind of...
And you're absolutely right. You're absolutely right. But that evidence as to where it'll stop is going to come from... We don't have yet. It'll come from China.
Do you think this is a circumstance? We keep talking about this firewall, this idea of... or a piece of news or inflection point. Is that what you're waiting for? Or do you think that there's
I think it'll
sort of herd mentality where everyone's going to go, okay, this is where it is? What's the...
I think what I'm waiting for is what the actual impact of all of that is, all of these things is on the activity level. That gives me, if China...
You're not getting that for a while.
No, but the Chinese PMI is coming out in next week. So I think we will start getting evidence. I mean, if it is in the 30s, then we have huge issues. If it is in the high 40s, then we can look at it and say that, look, things can get really bad, but they can come back. We don't know that just yet.
And by the way, when I'm talking about these sort of tactical conditions, what you typically will see is a crazy rally off the low that gets a lot of kind of momentum behind it, and then it fails, and then you have to rethink it, or then you have the information that comes out that we were afraid of at the lows, and we have to have a test.
I think there's a risk of that happening with the Fed rate cut. So that is something that we have to be somewhat mindful of. That the Fed cuts, let's say this weekend. I'm speculating, let's say. If they do something and
you can just come out with an announcement the way Kevin has talked about that doesn't necessarily continue.
Yeah, but I think that'll give a temporary relief to the market. But I don't think that can be sustained. For it to be sustained, you have to have a good handle on what the impact is on activity level. We don't have that just yet.